Most people can name their stock portfolio return to the decimal point, but couldn't tell you what the 10-year Treasury yield is doing today. That's a problem, because there's a market worth over $130 trillion globally that determines your mortgage rate, your job security, and your investment returns. And most people couldn't tell you the first thing about how it works. It's not the stock market. It's not crypto. It's the bond market. And that gap in understanding is quietly costing them. My name is Alex, and if you've ever watched interest rates rise and felt the effects in your wallet without fully understanding the mechanism behind it, stay with me, because the bond market is the most important financial market most people never think about. And I'm going to show you exactly how it works and why it affects everything. You've probably heard that interest rates matter, but knowing they matter and understanding the system that actually produces them are two very different things. Most people are working with half the picture, and once you see the half they're missing, you stop reacting to financial news and start understanding it. And every investment decision, every business move, every headline about rates starts making sense in a way it never did before. Let's start with the basics of what a bond actually is. Here's something worth sitting with for a second. One of the most powerful financial instruments on the planet sounds, on paper, like something your grandparents clipped coupons for in the 1980s. But don't let the boring reputation fool you. A bond is just a loan. That's it. Strip away all the financial jargon, and that's the whole thing. Think about it this way. Say your friend Marcus is a contractor who wants to expand his business. He needs $80,000 to buy a second truck and hire another crew. He doesn't want to go to a bank, so he comes to you. You lend him the money. He promises to pay you back in 5 years. And in the meantime, he's going to send you a check every 6 months as interest. That handshake agreement between the two of you, that's a bond. Just an informal version of one. Now scale that up. When the US government needs money, and it always needs money, and it does the same thing, except instead of asking one person, it asks millions of investors all at once. It issues bonds. Investors buy them. The government gets the cash it needs right now. And in return, it promises to make regular interest payments and then return the full original amount at the end of the loan period. The investor who buys that bond receives two things: regular payments called coupon payments, a fixed dollar amount paid out on a set schedule, usually every 6 months. And then at the end, when the bond matures, they get back the original amount they lent, the principal. So if you buy a $10,000 government bond that pays 3% annually, you're getting $300 a year, $150 every 6 months, for however long that bond runs. Then when it matures, you get your $10,000 back. You've essentially been a lender to the United States government. And here's the thing that surprises most people. That's not some exotic Wall Street product. Ordinary Americans own government bonds through their retirement accounts, through pension funds, and through money market funds. If you have a 401k, that's your employer-sponsored retirement account, there's a reasonable chance a portion of it is sitting in bonds right now without you ever making a conscious decision about it. Now, companies do the same thing. When a large corporation needs capital to build a new facility, acquire a competitor, or simply manage cash flow, it can issue what are called corporate bonds. Same basic structure. Borrow money, pay interest, return the principal. The difference is that corporate bonds carry more risk than government bonds, because a company can fail in ways a government typically doesn't. So to compensate for that extra risk, corporate bonds usually offer higher interest payments. The bond market, taken as a whole, is massive. As of 2025, the US bond market alone sits at roughly $51 trillion. The global bond market is over $130 trillion. That's larger than the global stock market, by a lot. And yet most people couldn't tell you the first thing about how it works, which is actually fine, until you realize how directly it affects the cost of your mortgage, your car loan, your savings account. Because every one of those numbers is anchored to something happening in the bond market every single day. And the mechanism that makes all of that possible, the thing that connects bond investors to your monthly payment, comes down to one relationship: a simple but completely counterintuitive seesaw between a bond's price and something called its yield. So now you know what a bond is. But here's the question most people never think to ask. Why does the most powerful government on earth need to borrow money in the first place? It sounds almost absurd when you say it out loud. The United States can collect taxes from 330 million people. It runs the world's largest economy, and yet it has been borrowing money every single year for more than 2 decades straight. What's actually going on? Here's how to think about it. The federal government isn't just one thing, it's thousands of programs running simultaneously. Social Security payments going out to retirees every month, Medicare covering hospital bills for tens of millions of Americans, defense contracts keeping aircraft carriers in the water and satellites in orbit, highway maintenance, federal employee salaries, white interest payments on the debt it already owes. The list doesn't stop. And all of that costs money before a single dollar of tax revenue comes in. The government's income, mostly personal income taxes, payroll taxes, and corporate taxes, arrives on a schedule. But the spending never pauses. So, in almost every year, what goes out exceeds what comes in. That gap has a name. It's called the budget deficit. In fiscal year 2024, the US ran a deficit of $1.8 trillion. Not the total debt, just the gap for that 1 year. To put that in human terms, that's roughly $5,000 for every single person living in the country, spent in excess of what was collected in 12 months. Now stack 20 plus years of deficits on top of each other, and that's how you arrive at the national debt. As of early 2026, that number sits at around $36 trillion. It's a figure so large it stops feeling real, but the mechanism behind it is straightforward. Every year, the government spends more than it earns, so it has to borrow the difference. And the way it borrows is by issuing bonds. Think of it like a household that earns $90,000 a year, but consistently spends $110,000. Each year, they put $20,000 on a line of credit. After 10 years, they owe $200,000 plus interest. The household isn't necessarily irresponsible. Maybe they're investing in things that matter: education, a business, a home. But the debt accumulates regardless, and every year they have to go back to the lender. The US government goes back to the market, constantly. And here's something worth noting. The last time the federal government actually ran a surplus, meaning it collected more than it spent, was fiscal year 2001. That's not a typo. 25 years ago. Every year since, the government has borrowed to cover the gap. Now, is that catastrophic? Economists genuinely disagree. Some argue that a government with its own currency and the world's reserve asset can carry debt loads that would sink any private borrower. Others look at the interest payments alone, which hit $1 trillion in 2024, more than the entire defense budget, and see a slow motion problem that doesn't get talked about nearly enough. What's not up for debate is this: the borrowing is constant, the bond issuance is constant, and because the scale is so enormous, the interest rate the government pays on those bonds ripples through every corner of the financial system, which brings us to the mechanism that actually determines that rate. Because it turns out the relationship between a bond's price and its yield is one of the most counterintuitive and most important ideas in all of finance. Most financial concepts, once you understand them, feel obvious in hindsight. This one doesn't. Even after you get it, it still feels slightly wrong. And that's actually what makes it so important. Here's the mechanic. A bond has a fixed coupon, a set dollar amount it pays you every year. That number doesn't change, ever. It's baked into the contract on the day the bond is issued. But the price you pay for that bond in the market, that moves constantly. And here's the part that trips people up. When the price moves, the effective return you're earning, the yield, moves in the opposite direction. Price up, yield down. Price down, yield up. Always. No exceptions. Let's make this concrete. Say the government issues a bond with a face value of $1,000. It pays a fixed coupon of $30 a year. That's a 3% yield on the original price. Simple enough. Now imagine interest rates rise. The government starts issuing new bonds that pay $50 a year on the same $1,000 face value. Suddenly your old bond, the one paying $30, looks a lot less attractive. Nobody wants to pay full price for a bond earning 3% when they can buy a new one earning 5%. So the price of your old bond drops. Maybe it falls to $600. Now think about what just happened. The coupon is still $30. That never changes. But the person who buys it at $600 is now earning $30 on a $600 investment. That's a 5% yield. Same payment. Lower price, higher return. That's the seesaw. And it runs in both directions. When interest rates fall, the opposite happens. New bonds pay less. Your old bond, still paying that fixed $30, suddenly looks generous. Demand for it goes up. The price rises, and as the price rises, the yield, the return relative to what you paid, shrinks. Now, here's why this matters beyond just understanding the math. The yield on a bond isn't just a number on a screen, it's the market's live opinion about what money should cost right now. Every time an investor decides to buy or sell a bond, they're casting a vote. They're saying, given what I know about inflation, growth, and risk, this is what I think a dollar of future return is worth today. Multiply that by millions of transactions happening every day across pension funds, sovereign wealth funds, insurance companies, and individual investors. And what you get is a constantly updating consensus on the price of money itself. Consider what happened in 2022. The Federal Reserve began aggressively raising interest rates to fight inflation. Bond prices fell sharply across the board. The yield on the 10-year U.S. Treasury, which had been sitting below 2% for most of 2021, climbed above 4% by the end of 2022 and pushed past 5% in 2023. That wasn't just a number changing. That was the cost of every mortgage, every business loan, and every car payment in America, repricing in real time. A software engineer in Austin refinancing her home in early 2021 locked in a rate around 3%. Someone buying the same house in late 2023 was looking at 7.5%. Same house, same neighborhood, completely different financial reality. That's the seesaw doing its work at scale. Once you see how price and yield move together, you start to understand something bigger, how the bond market doesn't just reflect the price of money, it actually sets it for everyone. And that's exactly what happens when millions of these trades stack up into something called the price of money for the entire economy. There's a phrase economists use that sounds like jargon, but is actually just a precise description of something real. They say the bond market sets the price of money, and once you understand what that actually means, you start seeing it everywhere. Here's how the mechanism works in practice. On a regular schedule, the U.S. Treasury holds auctions. It offers a fresh batch of bonds to the market. Pension funds, foreign governments, banks, hedge funds, individual investors, and they bid. The yield that comes out of that auction becomes a new benchmark, a reference point, the market's current answer to the question, what does it cost to borrow money right now? But that auction is just the opening move. The much bigger action happens in what's called the secondary market. That's where all the existing bonds, the ones already issued, get bought and sold continuously between investors. And this market is enormous. On an average day, more than $900 billion worth of U.S. Treasury securities change hands. That's not a typo. Nearly $1 trillion every day. Every one of those transactions is an investor making a judgment call about inflation, about economic growth, about what the Federal Reserve might do next, about whether lending money to the U.S. government for 10 years at 4.5% is a good deal or a bad one, given everything happening in the world right now. And all of those individual judgments, aggregated across millions of trades, produce a yield, a live, continuously updating number that reflects the collective opinion of the most sophisticated pool of capital on the planet. That number is not set by a committee. It's not decided in a boardroom. It emerges from the market itself, which is what makes it so powerful and so honest. Now, here's where the gravity analogy earns its place. When yields are low, the return on safe money is low. Sitting in government bonds barely keeps pace with inflation, so capital moves. Investors reach for higher returns in stocks, real estate, private equity, and venture capital. Companies borrow cheaply and expand. Consumers take on mortgages and car loans without much hesitation. The whole economy leans forward. That's essentially what happened between 2009 and 2021. The 10-year Treasury yield spent most of that period below 3%, and for stretches of it, near zero in real terms. Cheap money flooded into risk assets. Stock valuations stretched. Home prices surged. Startups raised billions on optimistic projections because the alternative, sitting in bonds, paid almost nothing. Then yields rose, and gravity came back. When the 10-year yield climbed above 4% in 2022 and stayed there, the calculus changed for everyone simultaneously. Suddenly, safe money had a real return again. The incentive to take risks shrank. Borrowing got expensive. Companies that had been running on cheap debt had to reckon with refinancing at rates that made their old business models look fragile. This is the transmission mechanism. The bond market moves, and within months, sometimes weeks, the effects show up in mortgage applications, corporate earnings, hiring decisions, and consumer spending. It's not abstract. It's cause and effect, playing out across the entire economy in sequence. And the most important rate in that whole system, the one that anchors everything else, has a specific name. It's called the risk-free rate. It's the return you can earn by lending to the US government, with essentially no chance of not getting paid back. And every other investment on Earth gets measured against it. Every investment decision you have ever made, or will ever make, is being quietly judged against a single number. Most people have never heard it called by its proper name, but it's been shaping their financial life the entire time. It's called the risk-free rate. In practice, it's the yield on US government bonds, most commonly the 10-year Treasury, and it carries that name for a specific reason. The US government is considered the safest borrower on the planet. It has never defaulted on its debt. It controls the world's reserve currency. When it promises to pay you back, the overwhelming consensus of global finance is that it will. So the return you earn by lending to it is treated as the baseline, the floor, the return you can get for doing absolutely nothing risky at all. And here's why that matters for you personally. Every other investment, stocks, real estate, a small business, a startup, anything, has to clear that bar to justify its existence. If a risk-free government bond is paying you 4.5% and someone is asking you to put money into something volatile and uncertain, you should expect more than 4.5% in potential return meaningfully. Otherwise, why would you bother? That gap, the extra return you demand for taking on risk, is called the risk premium, and it sits at the center of every financial decision, whether you're consciously aware of it or not. Here's a concrete way to feel it. In early 2022, the 10-year Treasury yield was sitting around 1.5%. At that level, the risk-free rate was almost an insult. Earning 1.5% barely kept pace with a low inflation environment, let alone the inflation that was already building. So investors poured money into stocks, real estate, crypto, and anything that offered a better return. The S&P 500 had just come off one of its strongest multi-year runs in history. Home prices in mid-sized American cities were up 30, 40, and 50% in 2 years. Then the risk-free rate moved. By late 2023, the 10-year yield was pushing 5%. Now the math changed entirely. A guaranteed 5% return on US Treasuries started pulling capital away from riskier assets. Why accept the volatility and uncertainty of the stock market for a potential 8 or 9% return when you could get 5% with essentially zero stress? The premium for taking risks had shrunk, and the market reflected that. The S&P 500 went through a painful correction in 2022. Growth stocks, the ones whose valuations depended on cheap money and optimistic projections about distant future earnings, got hit hardest. Companies that had never turned a profit but carried billion-dollar valuations suddenly looked very exposed. When the risk-free rate reminded everyone that patience has a price, this dynamic hits closer to home than most people realize. When the risk-free rate rises, mortgage rates rise with it. The average 30-year fixed mortgage rate in the United States tracked above 7% through much of 2023 and into 2024. A family buying a $400,000 home at 3% in 2021 was looking at a monthly payment of around $1,600. The same home at 7% is closer to $2,600. Same house, $1,000 more per month. That's not a rounding error. That's a car payment, a childcare bill, a decision about whether one partner keeps working or stays home. The risk-free rate doesn't stay on Wall Street. It comes home with you, which raises the natural next question. If the bond market sets the bar for every investment in existence, how do the best investors and businesses consistently clear it? That comes down to 4 specific qualities, and understanding them changes how you evaluate every financial decision going forward. Most people think the goal of investing is to make money, and that's not wrong, but it's incomplete, because making money isn't enough. You have to make more money than the alternative, and the alternative is always sitting there, patient and risk-free, waiting to be compared against whatever you're doing. That's the real game, not beating the market in some abstract sense, beating the bond. Think about what that means in practice. If you run a business, every dollar of capital you deploy has an opportunity cost. You could have put that dollar into a US Treasury and earned 4.5% with zero effort and zero risk. So if your business is returning 3% on invested capital, you're not actually creating value. You're destroying it. Slowly, quietly, but definitely. Warren Buffett has said for decades that the risk-free rate is the gravitational force of finance. He's built his entire framework around one central question. Does this investment, after accounting for all the risk and uncertainty, clear the bar set by the safest alternative available? If the answer is no, he passes. Every time. So what separates the investments and businesses that consistently clear that bar from the ones that don't? 4 things. And they work together. The first is a durable moat. This is something that protects a business from competition over a long period of time. A powerful brand, a proprietary technology, a network that gets more valuable as more people use it. Switching costs make it painful for customers to leave. The moat matters because without it, competition erodes returns. A business with no moat might earn great returns for a few years, then watch margins collapse as rivals move in and undercut pricing. To consistently beat the risk-free rate year after year, you need something that keeps competitors at a distance. The second is pricing power. This is the ability to raise prices without losing customers. It sounds simple. It's actually rare. Most businesses operate in environments where raising prices means losing volume. The ones with genuine pricing power, think a software platform deeply embedded in a company's operations, or a consumer brand with genuine loyalty, can pass cost increases onto customers and protect their margins even when inflation is running hot. In an environment where the risk-free rate reflects elevated inflation expectations, pricing power isn't just nice to have, it's survival. The third is low capital intensity. Some businesses have to reinvest almost everything they earn just to maintain their current position. Airlines, manufacturers, capital-intensive retailers. They earn $1 and immediately owe most of it back to the machine. Low capital intensity means the business generates cash that actually belongs to the owner. Software companies are the obvious example. Once the product is built, serving an additional customer costs almost nothing. That gap between revenue and required reinvestment is where real returns live. The fourth is disciplined capital allocation. This is about what management does with the cash the business generates. Do they reinvest it wisely? Do they return it to shareholders through buybacks or dividends at the right price? Or do they chase acquisitions at inflated valuations because growth feels good in the moment? The history of corporate finance is littered with companies that had great underlying businesses and destroyed value through poor capital decisions. Discipline here is what converts a good business into a compounding machine. Together, these 4 qualities describe a business that doesn't just beat the risk-free rate once, it beats it repeatedly across different economic environments, across different interest rate cycles, and that framing, the bond market as the permanent benchmark against which every financial decision gets measured, is ultimately the most useful thing this market gives you. Not a prediction, not a signal to buy or sell, a lens, a way of asking the right question about any investment, any business, any use of your time and capital. Is what I'm doing after accounting for all the risk, all the effort, and all the uncertainty genuinely better than the simplest, safest return available on Earth? If the answer is yes, you proceed with confidence. If it's no, you have some thinking to do. So here's what this all comes down to. The bond market isn't a Wall Street abstraction. It's the mechanism that prices money itself. And through that, it quietly touches your mortgage, your retirement account, your job, and every business decision being made around you. A few things worth holding on to. Bonds are just loans at scale. Price and yield move in opposite directions, always. And the yield that emerges from millions of daily trades isn't assigned by anyone. It's discovered. That distinction matters. The risk-free rate is the honest benchmark. Every investment, every business, every career bet you make is implicitly being measured against it. Most people never make that comparison consciously. The ones who do tend to make better decisions. Now here's something worth sitting with. You've seen how the bond market sets the price of money. But who actually controls the supply of that money in the first place? Because the bond market and central banks are in a constant, sometimes tense conversation. And understanding how that relationship works changes how you read every interest rate headline you'll ever see again. If that question is already forming, good. That's exactly where we're going next.